Hey, what's up, my friend? So, in today's episode, I want to talk about the truth about support resistance that nobody tells you. So, here's the thing, right? It doesn't matter whether you're a swing trader, day trader, position trader, counter trend trader, support resistance is one of the most commonly used tools in technical analysis, and I find that it's important to really understand, right, how this particular tool works. And what's funny is that it is very popular, but it's pretty darn difficult to do a back test on it because support resistance, let's be honest, it is subjective. So what I'm about to share with you is based on my experience, based on my experience, years of trading support resistance, and based on my beliefs. I could be wrong. So what I'm about to share with you, right? Take the concepts, take the idea, validate for yourself, and find out whether it's true for you or not. So the first thing that I want to share with you is that support and resistance, the more times, right, you test support within a short period of time, the weaker it becomes. For example, let's say, the shares of McDonald's, a huge institutions, right, want to buy shares of McDonald's at $50. Let's say they want to buy 100 million shares of McDonald's. So what's going to happen is that whenever price retests $50 at McDonald's, you can imagine, right, that out of this 100 million shares, right, a number of them is going to get filled. So let's say 50 million shares of McDonald's get filled on the first test, then the price bounce higher. Then it retests back $50, maybe say 30 million shares get filled, the price rally higher. Then the price came back maybe after a few days and fill up the last remaining 20 million of shares, and then it bounced higher. And imagine this, right? Once all the 100 million shares are filled, and let's keep things simple, and let's say no new order flow comes in, and the price retests $50 once again. Do you think there will be a bounce? Or will the $50 level, the price level, break? Well, the price is likely to break, right? So this is why I said that the more times price tests, right, a level within a short period of time, the weaker it becomes because order flow gets eaten up, right? And if no new order flow comes in, right, that's where the level break down. It doesn't happen all the time, but generally this is the case. So this is why patterns are like ascending triangle, right? It's a bullish chart pattern because traders who are wanting to sell at resistance, once all the selling pressure at resistance is used up, this is where price makes a breakout. Likewise for descending triangle is just the example of the McDonald's one we talked about earlier. Whenever price retests support, a bunch of order flow get filled up. If no new order flow comes in, it retests multiple times. This is where the support level or area is about to break down. Okay, so that's the first thing, right? The more time support and resistance is tested within a short period of time, the weaker it becomes. And I know this goes against most textbooks that tells you the more times it's being tested, the stronger it becomes. But based on my experience, that's not the case. Number two, the longer the price is away from a level, the more significant it becomes. Okay, so let me take you back to 2000, right? The dot-com bubble, right? Nasdaq approached near 5,000 and then it collapsed all the way down. And it only revisited the $5,000 mark almost 20 years later or 20 years later. So you can imagine that $5,000 level has held up for close to 20 years. It is a significant level. Okay? And once a level is significant, right, you want to be paying attention to it because a lot of traders, right, will be watching that level. For example, those who bought in 2000 near the $5,000 mark, they watch their asset price collapse for a good close to 20 years. And it's only after 20 years do they see, right, the price revisiting, right, the highs after 20 years. So they feel a lot of pain. Okay, imagine in the rate for good 20 years. So that level becomes very significant. I'm not saying that the more significant it is, right, the more the reversal will occur. That's not true. Because if it breaks out of it, right, then you can imagine that at that point, right, the price is now trading at all-time highs, and there's a good chance, right, it will follow through higher. But if you look through the charts again, right, of Nasdaq, okay, the recent times when it retested $5,000, right, for the first time in close to 20 years, you notice that the price, it didn't just break out of $5,000 just like that. It came into the $5,000 level, and then it hesitated. It consolidated for a while because there is hesitation in the market. People know, right, that this level, right, in 2000, that was the highs, right? Will it break out higher? They're hesitating. So that's why the price consolidated for a good few weeks, right, before it finally broke out of 5,000 and to where it is right now. Okay, so the longer, right, the price is away from a level, the more significant it becomes. And this brings me to my third point. Support and resistance, right? When support is broken, it becomes previous support becomes resistance. When resistance is broken, it becomes previous resistance becomes support. And there's a couple of reasons for this. So let's say back to a typical stock again. Let's say the shares of Apple, right? There's a resistance at $100, and that resistance has been in play for, let's say, 5-6 months. So when the price breaks out of resistance at $100, and let's say it quickly move up to 120, 130, there will be a group of traders who miss the move, and they kind of regret, man, should have bought at $100, right? Look, now the share price has taken off and I'm not in the trade. So there is this regret over there. So what they'll do is they'll place a buy limit order at $100, right? Hopefully if the price does retest it, right, this time around, they manage to catch a piece of the move. Okay, so that's the kind of like the first group of traders who place, right, buying pressure at the $100 level. On the other hand, there could also be a group of traders who are, notice that, Apple shares always retest $100, couldn't break out, and they sell short at $100. Then the price broke out and they're in the red, they're losing money. So they're feeling the pain right now, say, oh man, I shot at $100, the price now is $120, I'm in the red. And if only I could get out at break even, right, I'll be contented. Oh Lord, please, right, let the price come back to my original entry price so that I don't have to take the loss. So what would they do? Well, if you're short at $100 and you want to get off the trade at the same price, you will place a buy limit order at that level again, right? To get out of the existing short trade. So with these two group of traders, one, with the fear of missing out, and the other group of traders who are, wanting to get out of at break even, this adds, right, buy limit orders or buying pressure, right, at this $100 level. And that's why, when price breaks out of resistance, it tends to become support. Again, doesn't happen always or all the time, right, but more often than not. Okay, and finally, the last thing that I want to share with you is that support and resistance, they are areas on your chart. I know I used the word lines a few times, but really they are an area on your chart. And the reason is simple. Let's say we use another example of, let's say, Coca-Cola. Let's say, there's a support of $70 at Coca-Cola. And when the price, reaches, say, at $71, $72, there will be traders, right, who are eager to buy, right? Because, price is already almost approaching support, right? Let me buy right now in case, the market doesn't, head down lower and makes a quick reversal, right? At least I am on board the move, right? So they are what I call the traders who are, what's the term, right? Traders who are over inches to buy, right? So they buy just slightly in front of support, right? Because they don't want to miss the move. On the other hand, there's another group of traders who are what I call the cheapskate traders. They want to get the best possible price. So for example, if let's say support is at $70, they will queue smack at maybe $69.90. They want to get the best, lowest, absolute best price of support. And they queue at $69.90. And here's the thing, right? In the markets, you have no idea which group of traders is dominant. Whether is it the anxious trader who can't wait to enter a trade, or is it the cheapskate trader who wants to get the best possible price? And that's why support, right, is an area on your chart. Is anywhere between $72 to maybe $69. That is your area of support. And this concept is the same as resistance. So don't treat them as lines on your chart. Okay, they are not lines, but rather an area on your chart. Okay, so with that said, quick recap. Number one, the more time support resistance is tested within a short period of time, the weaker it becomes. Number two, the longer the price is away from a level, the more significant the level becomes, because there's a lot of emotional baggage, right, at that price point level. And number three, when support is broken, it tends to become resistance. And when resistance is broken, it tends to become support. And number four, finally, support and resistance, they are an area on your chart. So with that said, right, I have come towards the end of today's episode. I wish you good luck and good trading, and I will talk to you soon.